So the big question is this: how do most agents who struggle to get the information that most successful agents hoard to themselves grow and prosper without this information? That's the big question, and this video cast is the answer. Welcome to Real Estate Rockstars. I'm your host, Pat Hyben. And now, for the review of the day. Okay, I got a review here from Kelly R888. Kelly R888 brought me to real estate. Kelly R888 brought me to real estate. I heard Pat on the Bigger Pockets podcast as a guest. Liked him, so I decided I would check this out. This podcast convinced me I need a career change. I got my license this past January, and I think I can contribute a lot of my first year success to Pat and his guests. This podcast has given me ideas and confidence to get my business off the ground. There's no better balance of industry trends and coaching in a real estate podcast. Keep up the great work, Pat. I appreciate all your help. 5 stars. Thank you, Kelly R888. Keep the comments coming, guys. I love them. And remember, I eat feedback for breakfast, so give me a 1-star review if you want, or a 5-star review if you want. I don't care. And the more reviews we get, the better guests we get. So please, subscribe first, and then leave us a review or wherever you're listening. Okay, Rockstar Nation, we have a great returning guest here, and this is an important guest, and I asked her to come back on for a reason, because a lot of you probably have not utilized the Great American, and this is not the right name, but the Tax Cut and Jobs Act for 2018. Basically, the new tax cuts or the new tax laws that are in effect for the next 7 years, 2018 today, now to 2025, and it's completely overhauled, and there's a lot of changes for real estate agents. And if you haven't utilized it this year, you still have time. You need to do it now. Start thinking about, squeezing some of this stuff in before the end of the year so you can take advantage of this. So we've got a tax expert on the line who's been on the show before. She was on 5/11, right? And she talked about stop throwing away money, real estate agents' tax mistakes. I'm talking about Diane Gardner. And I asked her to come back to shed some light on, what's going on with this 2018 gig and what agents should be doing differently. So, Diane, welcome back to Real Estate Rockstars.
Pat, thank you so much for having me back. What an honor to always get to come back and do a repeat performance of new information.
Hey, we matched today. We're both wearing our, hunter green.
It's fall, I'm glad you got my memo. We were able to color coordinate.
Hey, why don't you give some quick background on yourself so the Rockstar Nation can get to know you a little better?
Well, Pat, I am a tax coach, and people go, what in the heck is that? A tax coach is different than a traditional accountant in that I get to come alongside you, and together we prepare a plan for how we're going to help you save money on your income taxes and how you're going to plan your way to a lower tax liability with my expertise and my help, and then set up a plan to be able to implement it so that you can decrease that amount of tax that you owe to the IRS. To date, I've saved my clients $1.872 million in tax legally by using IRS-approved tax strategies. So that's so much fun to get to meet with people and sit down and come up with ways and knock off anywhere from $5,000, $10,000. I've had them as high as a couple $100,000 worth of tax off of their tax returns each and every year going forward. So it's so much fun to get to work with people.
That's awesome. And we got to get that up to 2 million because that's such an odd number, 1.8725431. All right, Diane. So give us Now, let's talk about this, right? Let's talk about the new tax plan and how real estate agents and people in the real estate game, real estate investors, because we're going to be giving advice as agents. We give advice to real estate investors, obviously. You know, specifically, I want to know what we should be doing differently than we already were. What should we be asking our accountants, or what should we be doing ourselves differently?
Well, one of the areas that affects real estate agents dramatically under the new tax law was they changed the rules on meals and entertainment. And that affects real estate agents because they spend a big portion of their out-of-pocket expenses are in that area. They're meeting with their clients. They're having meals. They're meeting for coffees. They're doing this kind of stuff. They're taking them to places that, you know, they're wooing their customer base.
Yep, and most are buying their own drinks on it as well. And
yes,
okay, so in the past, like, and I've known this in the past, you've basically you take a client out for drinks, or you buy them a cup of coffee at Starbucks. You can write off 50% of that if you call it meals and entertainment. But if you called it promotion, you could write off 80% of it. Is very ambiguous as to what was considered promotion and what was considered meals and entertainment. But and I know a lot of agents skirt to the side of promotion versus entertainment and write off 80% of that. What can you tell us about what we need to do now?
Well, what we need to do now, number one, is the entertainment piece is completely gone. So if you took your client to a game, a sports event of some sort, here where I live, taking people on fishing trips, they like to run up to Alaska and take them on a big cruise or something. Those things are gone. Anything that was in the entertainment side is completely gone as a deduction. That knocks out golf. It knocks out any of those
games.
If you had
what about a client appreciation party?
That's different. That falls under different rules.
Is that promotion?
That is promotion, because at that client appreciation party, you are going to talk about your business. You're going to put a business spin on it.
What percentage is that now?
That'll be 100%, provided you put that business spin on it. You talk about, here's the homes I have listed, here's what we're the top #1 agent, and blah, blah, blah. But you have to show that business reason for being there, not just that you've invited some friends over for some drinks and food. You have to talk about your business.
It used to be 80?
I don't think so. I think it's always been
100. Okay.
Provided you put that business, you have that business talk in there. I do a large client appreciation event myself, and we make sure that I talk for about 15-20 minutes about something to do with their businesses. So
what if I take somebody golfing? What if I take three past clients golfing, and pay $700, and take them out for drinks and dinner and blah, blah, blah. And I talk about business. Would that be, promotion, 100% write-off?
Well, potentially the drinks and dinner part can be a write-off, but it really is a 50% write-off, because it's going to fall under that business meals, not really promotion so much. But the golfing piece, because you had fun there, is not going to be deductible now. So
wait a minute. What if I have an egg toss at the client appreciation party? Are they going to say, "Hey, that's fun"? I mean, how do they define fun? You know what I mean? It's a fine line.
I know. It is a very fine line. But things, from what we've seen, is it's the golfing, it's the sporting events, it's those kinds of things that were considered entertainment that are now gone.
Okay, so what if you just write, instead of labeling it golf, you label it client appreciation golf party?
I'm not going to get into specifics, because you'd have to look at each situation individually.
So it's still very
a hard time. Yeah. I think an auditor would tear that up pretty good. I don't know. I would think, because they're going to come down on the hard side, and you're going to have to prove to them it's not.
What about these agents that have client appreciation parties in movie theaters where they show a movie and buy everybody popcorn?
That I'm not sure, because we have a whole new set of rules now. Before it was no problem. Now I'm not sure. We're going to have to really get into the specifics of
So before you could unequivocally write off golfing, you could unequivocally write off
you
the
bet.
movie theater, anything, and now, and you would write off the movie tickets and the staff and stuff like that. 100%. You would write off any food, right? Popcorn, Diet Coke at 50%. That was the old rule. You had to itemize it, right? Into food and whatever, promotion, which was 100%. I thought it was 80, but 100. And that maybe it was 80 a long time ago. I'm antiquated there. So then, now you're testing the waters. Now, basically you could do it, but if you get audited, you got a good chance of losing the write-off for the popcorn, the Diet Coke.
Maybe. We don't know, because there's no court cases out there yet. There's no private letter rulings. There's no nothing, because this is all brand new law. So over the next couple of years, we'll have answers to those questions, because things will have happened, people will have been audited, and they will be setting where is that line in the sand. We don't know at this point.
But if you hire an extremely conservative accountant, that accountant may tell you, you can't write off that Starbucks Frappuccino you just bought a current client you're showing houses to.
I would hope not. Hopefully they've taken some classes on this new tax law and they wouldn't do that, but who knows? I've seen some.
If it's not a meal, what is it?
Right.
What's a Starbucks?
Well, if you're meeting someone for coffee and you're buying them coffee, that falls under business meals. Because you're talking business.
I thought you said that it was you can no longer write it off.
No, business meals you can, not the entertainment piece, which is your sporting events, it's your fishing trips, it's your golfing, that kind of stuff.
So you can still write off the meals. And is the meals, what percentage you get on that?
Fortunately, we got some clarification from the IRS just a couple weeks ago, and meals are at 50%. Up until that point, they were at 0 for business meals. And they got a lot of pushback on that from the whole business community. And they gave us clarification about 2 weeks ago that said business meals will be 50%.
And 50% is asinine, in my opinion, because if you take 4 people out, technically your portion is 20%, their portion is 80%. So you should be able to write off everybody's but your meal. But whatever. Okay, what else, dude? Let's get off.
So that's a big one though in the real estate industry. Huge, because I see what my clients spend in meals and entertainment. Well, another one that they're going to like is with the new tax law. Overall, the tax rates have been decreased. So that should make everybody happy out there. And that should show savings on people's tax returns. We ran about 30 of our clients through the new tax law during our last tax season. And just that reduction or decreasing in the rates seemed to save my average client about anywhere from $800 to $1,200 in tax.
Okay, talk about that briefly. Talk about the numbers real quick.
So in the past, our tax rates went from 10% up to 39.6%. So they have taken each tax bracket and dropped it down a couple percentage points. So if they were in the 25% bracket previously, they're now in the 21% bracket. If they were in the 15% bracket, they're now in the 12% bracket. And that's where most people tend to fall, is right in those two brackets. So just that couple percentage points will save people money on their taxes this year. So that's a nice little perk that they may not be aware of.
Straightforward. Yeah. What else?
That was pretty nice. Another one that we have for us this year is a new deduction called qualified business income. I'm not sure if you've heard anything about that. QBI.
Tell me about QBI. What do I need to know?
QBI is a very complicated topic, so I'm going to really oversimplify it.
Yeah, please dumb it down for us.
I will, because I could just put your whole audience to sleep with it. So I'm going to back up a little bit. Back during when this new tax law out, the whole reason behind it is Congress wanted our in a worldwide market. Well, the majority of the companies that are competing in a worldwide market are C corporations. So they lowered their tax rate from 35% to 21%. Well, if they did that, then they had to do something for the rest of us, because now all of a sudden we were paying more tax than your C Corps were, and they knew that all of us would just run out and turn our businesses into C Corps and be done with it.
Brokers and team leaders, are you tired of seeing dwindling numbers at your monthly sales meetings? And I don't mean numbers as far as sales, I mean numbers as far as agents attending. Do you struggle with creating new and exciting content that will not only motivate your agents, but deliver actual results to them? Do you want your agents using proven sales techniques that increase their commissions? We've got the answer for you. Rebus University is launching a Lunch and Learn series you can purchase to provide structure and content to your meetings. The series has 12 30-minute trainings taught by me and top producers from around the world, and specifically is designed to increase production for your agents. Plus, when you purchase these trainings, you will also receive significant discounts for the go-getters on your team or in your office who want more training and bigger results. So don't delay. Go to hibandigital.com/teams. That's hibandigital.com/teams, or call Catherine Brower today at 843-749-9900. That's 843-749-9900. And get started with your Rebus University Lunch and Learn. So C Corps, when you say worldwide market, basically you're saying if you want to deal with companies outside of the United States of America, you have to be a C Corp.
No, most of them are C Corps. You don't have to be, but most of them are. And I'm thinking, the bigger ones that have traded on the stock exchange, those kinds of companies are C Corps.
Got it.
Which means that the corporation pays its own tax, as opposed to somebody who might be operating an S Corp or a sole proprietorship or in a partnership or an LLC arrangement. Those types of entities, that tax flows through to your personal return, and you pay the tax on your personal return. So it gets charged at whatever your personal tax rate is. So anybody at the 25% on up to that 39.6%, we're going to pay more tax in those entities than a C Corp would at the new 21% rate. So they had to equalize the playing board. And they did it in a very roundabout, complicated sort of way. Yeah, I mentioned that, right?
Roundabout complicated. That's an oxymoron, but go ahead.
It is. So what it boils down to for real estate agents is you will take your net profit from your business, whether you're a sole proprietorship on a Schedule C, you are, or in a partnership with somebody else and you have a partnership tax return where you get a K1, or if you're operating as an S Corp and you get a K1. All of those things will flow to your personal return. You'll take that profit, and to really oversimplify it, you're going to multiply it times 20%, which will give you a new deduction on your income tax return, which will in effect decrease the amount of tax that you're going to pay on that business profit. Did I do that simply enough?
You did it simply enough, and it makes a great case for the flat tax of
Yeah.
But go ahead. Okay. So that's new, right? And it's kind of even the playing field, which in the long run helps people, helps real estate agents save money, right?
Right. Okay.
So
now we need to look at various planning strategies. In the past, we all took maximum depreciation, used Section 179 whenever possible. We're writing off vehicles as fast as you could write them off. So now we need to look at, is it better to do those same strategies that we've always done, or is it better to have a little more profit and take a higher QBI deduction? And the only way to know that is to run the numbers.
So you got to make sure your accountant or you run it both ways. And then what you're saying is the taxpayer has a choice. Pretty
much, right. And I would say with this new QBI deduction in there, I would highly recommend people not try to do this just themselves. Use an accountant, somebody who understands the new tax laws, got the training, knows how to run these various scenarios, and can give you the information to make the better decision, which is going to give you the better outcome.
Yeah, I wonder if there's probably some calculators online or some tools that you could get that will run it for you. But you're right. The easiest way is to get an accountant to do it and done. Okay, so let's talk about, okay, what else you got? What other things we need to be aware of, or what are some things that, people listening could say, damn, I didn't know that. I got 60 days left in a year. Let me jump to it.
Well, those are the two biggest things that's going to really affect real estate agents. We have some things that if anybody is in the process of getting divorced, and we're talking about alimony. Under the old rules, alimony was deductible by the person who paid it, taxable to the person who received it. Under the new rules, starting in 2019, alimony is no longer deductible or is not taxable for the receiver.
Well, personally, knock on wood, I've never been divorced, but that doesn't make any freaking sense, really.
I know.
Why would it be deductible? Right? It's like,
Yeah, I met with a client.
You know what I mean? It's like you're paying a fine, or you're paying for child support, or what? Whatever. Is it?
Yeah. Yeah, I was on a call with a client yesterday who was paying about $50,000 a year in alimony. Fortunately, if you already have your agreement in place, you're grandfathered in, and he'll be okay. But when we were talking about the new tax law, he says, "Oh my gosh, I'm so glad we got this settled in 2017, not going forward, so that he can still take that as a deduction because he's the payor." And
it's just the concept of being able to write it off is stupid to begin with, because you're rewarding people for getting divorced.
Well, yeah, I guess if you're the one paying it out, though, you're really happy that. Of
course, but I'm just saying from a business standpoint.
Oh yeah.
Right? If I was king of the world, I would have never thought of that idea. Hey, you got the
right.
Congratulations! I'm going to give you a benefit.
Right. Yeah. So that was a big one in his case,
right?
Because he lives in a state that's very alimony friendly, and so they're always giving alimony and stuff.
You ain't kidding. 50 G's.
Yeah. Alternative minimum tax. Have you ever got caught with that showing up on your tax return and you're wondering where did that come from?
Yeah, right.
Yeah. They've raised the threshold on that particular tax, so fewer people should get caught in it. It had not been indexed for inflation for many, many, many years. And so it was getting to the point that, I don't know, about a third of my clients kept getting caught in it, that they weren't wealthy by any means. They were just your average person with a decent business, and they'd get caught with alternative minimum tax. So now the thresholds have been raised, and so they're estimating that maybe only 10% of the people will have to deal with alternative minimum tax, which is for those who aren't familiar with that.
What did it used to be, you think?
I don't know. I had about a third of my clients, so I don't know what the overall amount would be. But for those who aren't familiar with alternative minimum tax, it was originally set up to be a tax for the wealthy, and it was to make sure that they paid their fair share amount of tax and that they didn't plan their way to too low of a tax liability. And so they would get caught with either regular income tax or alternative minimum tax, and that it brought them back up to have to pay a certain amount of tax. And it's a surprise when your average business owner gets caught in it, or your average real estate agent gets caught in it, when you don't qualify as that wealthy definition. So they fixed that under the new tax law.
How'd they fix that? Right?
They fixed it by raising the threshold, so you have to have much higher income now to get caught in it. So had they indexed it for inflation over the years, it probably wouldn't have needed this fix.
And I don't even know if it works, right? I mean, you look at the Trump family, or as an example, people like that. I mean, they still figure out ways to get negative taxes, even with the alternative minimum tax, right? Negative incomes, so they don't pay anything, right?
Well, yeah, and I believe that there's a lot of some capital losses and things like that were carrying forward that they were able to utilize, and then that's completely different than just paying tax on your business income.
Right, but yeah.
So, yeah.
Yeah, but what I'm saying is just ways to get out of it. But no,
right.
It makes sense. I get it. Okay.
Yeah. So new planning ideas on the hiring your kids. Standard deduction is now doubled, basically, from what it was previously. So it used to be $6,350. It's now $12,000 for a single person, $24,000 for
slow that down. What do you mean by that?
Okay, standard deduction. In the past, you would take your taxable income. You would subtract your either standard deduction or itemized deductions.
Oh, I got
Then
you.
you would
Right, right.
subtract
If you
your
don't
personal.
itemize, you get a standard deduction of
Right,
63.50 per kid. Now they've
right,
jacked it up.
to
All real
12,000.
estate agents itemize. I mean, if you're a real estate agent, you don't itemize,
Well,
something,
not
you're not
all.
selling anything.
Well,
Well,
because
unless they're on a
itemizing,
salary, right? I mean,
well, no, because itemizing has nothing to do with your business income. It's your personal life. It's do you have enough mortgage interest, state and local taxes, charitable contributions, that
so
type of stuff.
basically you would itemize if you spent more on your, let's say as a real estate agent, if you spent more on expenses to run your business than today, 12 grand used to be
No.
6,000.
Yeah, no, no, no. That okay. On your business, you have your business income minus your expenses gives you your net business profit. That flows over to your personal return, and that gets taxed as income.
Right.
Itemized deductions were if you had to own a home with a mortgage on it to have enough to be able to itemize. So it was your state income taxes or sales tax. It was your property tax on your home, mortgage interest on your home, charitable contributions, those kinds of things made your itemized deductions. It was a Schedule A on your income tax return.
Oh, you're right. I get it.
Yeah.
Right.
So now that standard deduction is doubled, we'll have fewer people itemizing, but it's a great tax planning tool for when we hire our kids or hire another family member, whether it's a parent, a kid, whoever, because before we were limited to paying them the standard deduction amount of $6,350, and then they wouldn't owe any tax on it. Now with that standard deduction doubling up to $12,000, if we're hiring our kids and using them in our business, we're able to send $12,000 down to a potentially zero tax bracket by passing that money down through your kids and using them in your business.
Okay, so to simplify this, if you have children, let's say you have 3 children, you can write off $36,000 a year, right? Just like literally take that off the top of your income by paying them each $1,000 a month to model and take pictures for a postcard that you use, or a Facebook ad, or shred paperwork, or whatever it is you want to do. You can hire your children at $1,000 a month, and that is a automatic deduction from how much you earn.
It could be. There's some logistics that have to happen in the background. You got to keep track of what they do. You need to keep a time card. You need to pay them on payroll, like real payroll. You need to do some things to make that deduction work.
You can't just pay them. You can't just Venmo them $1,000 or just put $1,000 in their uniform gift to minors account. You got to put them on payroll.
Yeah, you need to put them on payroll.
8-year-old on a payroll.
Right. The IRS says they have to be at least 7 years old.
Are you allowed to do that? You're allowed?
You are.
Is there a minimum you could make? Because I remember when I was 15, I'm 53 now, but I remember I was 15, I got in trouble with the IRS because I worked too many hours, and they said, this kid is working too hard. What can that happen? Can they say the 7-year-old is a slave labor because they're making 12 grand a year?
Generally, the IRS has said that when a child works for their parents, that they're not subject to some of those labor rules. Now, that might be governed differently from state to state. So you want to check your state on that, because they're the ones that like to look at that stuff a little bit closer. But if you're using your child in your business, and I don't know that you could justify paying a 7-year-old $1,000 a month. You have to look at things that are age appropriate, that they have the skill level to do it, that you're paying them an appropriate rate for what they're doing.
A lot of people could say, hey, I'm taking pictures of them and I'm putting them on Facebook, and then
what would you pay somebody else to model? So
right. What would I? Yeah, if I took pictures of a fake family and put them on Facebook, and that was my quote unquote promotion of, hey, I'm a family realtor.
So you have to always look at it. What would you pay somebody else? Document that in case you're ever challenged on it. Put your children on payroll. If you operate as a sole proprietorship, anything that's non-corporate, you generally don't have to withhold Social Security and Medicare and things like that, but you do have to issue them a real.
And so is the 12 grand like a gross salary, like $1,000 a month gross salary, or is that a net? Like, do I have to gross? Okay, so I pay the payroll company, or I pay, or I just do figure out the taxes myself on $1,000 a month gross per kid.
Well, there wouldn't be any taxes if you operate as a non-incorporated business.
Oh,
Because there's not going to be any federal state withholding, and there's not going to be Social Security or Medicare. If you operate as an S Corp or something like that, you have to at least withhold the Social Security and Medicare.
Got it.
So it just raised that from $6,000 to $12,000 as a way to pass down some income. I look at it at the flip side. You've got people out there who are supplementing their parents in their later retirement years. Can you use them to help in your business?
All right, Rockstar Nation, we have a super duper Black Friday, Cyber Monday special just for you, just for the holidays. This thing is bombastic. This thing is close to 85% off. The biggest sale I've ever had. Listen up, Rockstar Nation. A lot of you are enjoying the Rebus University courses, and I really appreciate that. These courses are changing lives, doubling, tripling, quadrupling agents' businesses. But don't believe me. Listen firsthand here.
So this is Connie Carlson, and I don't even remember how I stumbled across Rebus University, but I was super impressed with the lineup of who was teaching the courses. I know a number of those trainers, and I know that they are exceptional in their field. So we were able to work out with Rebus a way to offer the university to all of the agents in our brokerage. And the agents love it because they can watch what they feel they need, whatever course they need, whenever they need it. So I can say that our business from 2017 year to date compared to 2018 year to date, our volume is up 48%. Our average sales price is up 11%, and the number of transactions is up 34%. So by implementing what they're learning, it is definitely helping the agents sell more homes and also giving them more confidence and being able to compete with some of the top agents in our area. So I highly encourage Rebus. I'm going to be using it as a broker to help recruit other experienced agents, and hope to, through using that training, have the best real estate brokerage in our area.
So what I'm doing is, for a limited time, I'm giving you access to all of the courses. Every course, certified listing agent, which is 8 agents doing their listing appointment, something they would never do in their local market, but they did for me on film. It's a certified buyer agent course, outbound lead course, everything you could think of on ways to get more business and more commissions in this game is included, right? Included for you to take throughout the entire year at an 85% discount, including new investing courses from real estate moguls who are multimillionaires from real estate investing, and our newest product, which is the Retoot Secrets, stands for Recruit and Retain, from 3 industry icons who have recruited tons and tons of agents over the years on their recruiting secrets. All of that mixed into one for 85% off. All you need to do is go to Rebus Sale, REBUSSALE. 2 S's in the middle, right? Because you got Rebus and you got Sale. RebusSale.com. That's REBUS Sale, SALE.com. Or text the word sale to 444-999. That's sale to 444-999. Yeah, you know, I did this when I was selling real estate, and so I'm familiar with it. And you know, the funny thing that happens, and this is a true story, right? It happened to me recently. So what I did, you know, as a parent, right? You're not really taking an 8-year-old and Venmoing them money into their bank account, because that's silly, right? You're putting it in a uniform gift of minors account with your stockbroker, let's just say. So 12 grand a year, you're like, oh shit, what is my 8-year-old going to do with $12,000? Well, you put it in an UGMA, and it goes into your, you know, tell me if I'm saying this wrong. You put it in an account, right, with your broker, whatever that account. It might not be UGMA, that might be something else. You put it in an account, it keeps going in that account, and it builds up. Now, here's the funny part. So I did this, and what happened was my kids turned 21, and I wanted to get out of the stock market because the stock market, I figured, it's peaking, whatever. Let's put this in something more conservative. So I emailed the stockbroker, and the broker was like, you can't make decisions on this money anymore. I'm like, what are you talking about? That's money that I saved. They go, no, this is your kids' money. And so suddenly my children had all this money, and I'm like, well, wait a minute, I don't want to give them that money.
It belongs to them. Yes.
And it belongs to them. So be careful. If you jack up 12 grand over 10 years, that's 120 grand. You know what I mean? And not to mention what it grows in the stock market. So you got to be willing to be prepared. So luckily what happened was we sat them down and we said, okay, here's this thing. Guess what? Number one, happy days. Now you got this money that's you have to make decisions on. But number two, can we have a family rule that like you only use it for weddings, education, or buying a house? And they agreed, thank God. But like if they were massively, whatever you want to call it, whatever adjective I'm looking for, if they didn't want to listen to their parents, they could have just been like, no, give me the cash. You know what I mean? I'm going to Vegas. So
Right.
you just have to be conscious of this, because this is a true story. This is what happened to me.
Yeah, but just think, Pat, what if you could have put some of that off in a Roth IRA for them and let it just sit there and roll for the next 30 or 40 years?
Right, and I did that. But I think you're limited on that too, right?
You are limited to a certain amount, but I always look at if you could throw that out there as a parent for them instead of just putting it in an account that they're going to be able to put their hands on at 21 or actually I think it's at 18. It actually technically became theirs. If you put some of it over in that Roth IRA and it just sat there, even if they didn't contribute it to it during their 20s and 30s when they're raising families and that kind of thing, and then started contributing again to it a little bit later, they'd have a nice nest egg out there at retirement time.
And so
that's have so many years to grow.
That's the answer, everybody listening. Maybe you just want to give them enough so that it just goes into the IRA and then stop paying them. So there isn't this extra money. Or, like I said, just set it up and say, hey, by the way, when you turn a certain age, you're going to get this money. And I want you to agree that you're not going to blow this, that this is going to go towards your college or go towards your first house. You know what I mean? So long as you have a family rule up front, I think it's a great idea. Just be careful.
Yeah, but it makes a nice tax planning strategy for us.
Absolutely, 100%.
Yeah. Flip it around or advance it a few years. Now they're going to college and they're home for the summer, and you've got them working in your business. It's a nice way that they can earn that money that you would give them anyhow to help supplement their room and board and stuff as they're going through college. So it's a way to take something that would be an after-tax write-off, move it into a pre-tax write-off by utilizing this increased standard deduction.
Right. And at three kids, that's $36,000 a year. And, if you're in a 40% tax of that, right, that's like 15 grand a year you're saving in taxes, and you're getting your kids a retirement or giving your kids college money, or, it's a bombastic strategy for sure.
Yep. Now, on the new tax law, in addition to doubling the standard deduction, which sounds really wonderful, they took away the personal exemptions. So before, Pat, you had a personal exemption for yourself and your wife of right around $4,000 each. That deduction is now gone. And they tried to equalize it by doubling the standard deduction. So in theory, it'll come out real similar to where you were in the past. But because it's the double standard deduction, it gives us more planning ability for that, paying your kids or paying your parents, those types of things. People who are on the lower tax bracket schedule rates compared to where we are right now. Another nice thing that's going to affect everybody, not just real estate agents, is that child tax credit. For kids that were under 17 years old, it's been $1,000 a year for quite some time now. That number has doubled to be $2,000. So that
And
is
that's
going
a
to help.
complete credit right off
That
your
is
tax.
that
It's
is
not a
a
deduction, but a
yes.
credit. Boom.
Credits are dollar for dollar right off of your tax. Deductions are based on your tax rate. If you're at the 25% tax rate, you're going to save 25 cents on every dollar. Credits are dollar for dollar.
Keep having kids because you get this credit, which is interesting in itself, right? Because kids, you got to put them through public schools, and they use just as much public stuff as adults, but
right.
get a benefit for having them. So it doesn't make logical sense, but whatever, we'll take it, right? Okay.
You will take it. Yep. We have a new family credit for people who would normally have had a dependent for somebody other than your child. So this kind of looks back to maybe mom and dad have moved back in with you, or mom or dad, because the other one maybe has passed on, or maybe another family member. So we now have a new $500 credit for them because we've lost them as a dependent. So we can pick up this $500 credit.
So if somebody moves back in, and it has to be paternal. Like can it be a kid that got fired from their job and they're down on their luck and they move back in, they're 30 years old?
They could, yes, it could be. It's somebody who does not qualify as a dependent, which is normally under 18, or
anybody,
if they're a college
right?
student up to
24. A homeless guy off the street, you bring him in and boom, you get $500.
It could, if they met the rules, then potentially yes. So it's somebody who is because they call it a family credit. So I don't know that a homeless guy would qualify. I think they have to be related to you. But that's a new credit out there. It's a non-refundable credit. So if you don't have enough tax to eat it up, you're not going to get it as a refund. It will just help reduce your tax. So that was kind of a new little perk out there. Trying to just think of some of the other things that really affect real estate agents. Depreciation was one. I know this is not a huge item because they don't have a whole lot of assets they buy, but depreciation got a complete.
How do you know?
Because I see their tax returns. I do them.
Most agents are saying most agents are false prophets and they don't buy what they sell.
No, I'm not talking land and buildings and stuff. I'm talking equipment and things like that.
You're talking about cars and stuff. Okay.
Cars and computers and heavy equipment, like my construction related clients. They got tons of equipment on their depreciation schedule.
I got
Real estate agents have small depreciation schedules.
Yeah.
So
okay.
We have an overhaul of the depreciation. Some. Right. And so now we have some 100% what they're calling bonus depreciation, which means we can write things off in the first year. So that's going to be nice. We were down to some 50% bonus. We still have
so let's talk about that. So let's say I go out and buy a new Cadillac Escalade and I'm an agent, right? And I pay cash for it.
Is that Cadillac Escalade over 6,000 pounds?
Let's just say yes. I have no idea. I mean, you tell me
right?
What's qualified? What are they trying to do with that?
Over 6,000 pounds, and that Cadillac Escalade has a bed on it like a pickup, right? Or something along those lines. We got to get that gross vehicle weight, the GVW, up over there and meet a couple other requirements. If it's over that 6,000 pounds, then it potentially qualifies as a piece of equipment. It's no longer a car or a luxury auto, and it falls under these new rules then of a piece of equipment. So
and then what? Then you write
then we could write it off in the first year. Yes.
Okay.
So that's some pretty good stuff for planning purposes there. It's not going to help everybody tremendously, but it will help some. There's some new rules on those of us who own rental properties and the ability to write off certain things there under some of these new depreciation rules, especially if you own.
Hold on a minute. I don't mean to sidetrack here, but the weight of a Cadillac Escalade.
Oh, you're looking it up. Okay.
What they call curb weight.
We want the GVW.
Oh, because this says 5,500. GVW is different than curb weight?
I think so. I don't know why. I don't understand them, but.
Curb weight. Okay. All right, keep going. Sorry.
Okay. That's okay. Anyhow, some great new rules, especially if you own a building that you're using for your own business. So under the self-rental rules. So in my case, I own the building that my accounting firm is in. The profit that we have on our Schedule E will now qualify for the QBI deduction. So that's pretty cool. And it's going to potentially qualify on some other types of rentals as well. So they've included the rental industry in with the qualified business income, where before it was always considered you're passive, you don't get all the same rules that a business does. They've pulled that into the qualified business income. So that's going to be good news for a lot of the rental schedules.
Yeah, absolutely.
Yeah, give us more money to use that QBI deduction on. There's some really great rules out there that have nothing to do with the new tax law for investors or even just your average person who's selling a piece of property, who sells for more than $600,000 or so, that has some decent capital gain built into it. And that is an area that I love to do tax planning in, because we are able to defer the tax on that for 30 years and loan that money back to the owner of the property. So they now have that money to take and invest in another property. That's not like a 1031 exchange where you have to, have your property identified and be able to do your swap on time and all that kind of stuff. You can do whatever you want with that money. And we defer the tax out there for 30 years. So we have them.
So wait a minute, dumb this down. So I sell a property for $605,000.
And you paid $200,000 for it.
So I made $400,000. I was going to get taxed on that 400 gain.
You're going to pay 20% tax on it plus whatever your state rate is.
And instead of doing a 1031 tax deferred exchange and buying something else at the top of the market, and and just basically making a horizontal move to something else, right? Which a lot of people are like stuck right now in today's market.
Yeah.
They're like,
they don't want to do a 1031,
but I'm going to overpay. I'm buying at the peak. I really like to cash out, right?
Right. Yep. They want to cash out.
But I don't want to get taxed.
Right.
So what do I do?
So now you and I are talking. I'll run out some numbers for you. We use a third-party administrator who basically steps in and he loans you your proceeds so that you've got your cash. We have you invest a certain amount of those proceeds into a stable, conservative vehicle that would get you to the amount of tax that you're going to owe at the end of 30 years. And if you're no longer on this earth at the end of 30 years, that money will be there and your heirs will pay the tax at the end of the 30-year time period.
They'll pay the. So all you're doing is deferring it for 30 years. You get if you're 90 years old, you can't just sell everything and then have all this gain and then say, I don't care, I'm not going to be living to 120, because somebody's going to get whacked with that.
Well, not if we
die.
Well, not if we do this right, because you will have that cash from the sale of that property. So you're going to have your $400,000 back in your pocket, and we're going to say we need to invest. Let's say it's $60,000. So that over 30 years it grows enough to pay the tax, or we need to invest.
So you you calculate. Oh, I got you.
Yes.
You calculate. Yes. So let's just make it simple. So you make 400 grand on this thing you sold for 605 that you bought for 200, and you take 100 of that and you say, let's plug this away in a small cap fund, and it's going to grow to 400 over 30 years, and then let's take the 300 and just spend it. Right.
Right. Right. We wouldn't even.
I don't have to pay taxes on my 400 grand.
Right.
Until I die, and then when I die, that 100 that's in the small cap fund will have hopefully grown to enough taxes to pay for the 20% of the, or let's say 30% of the 600, which would have been 90 anyway. So yeah, absolutely.
Yeah. So you would, let's say you only invested 50 of it to grow to the 90. And that 50 at year 30 becomes the 90 and the tax is paid. And meanwhile, you got $350,000 back in your pocket. You can either buy another property at the top of the market, or you can hold and wait, or go to a market that isn't at the top.
Yeah, and that's a pretty good deal, actually.
It is. It's a wonderful deal, because
you might invest the money anyways, right? You're like, okay, well, I don't want to do real estate because real estate's peaking. Let me just do a bond or something, and then.
Or you're going to do, who knows what you're going to do with it, but it gives you that freedom that you're not stuck into a 1031 exchange, which are not working real well right now because of what the market's doing. Yeah. So we've been able to do several of these for our clients, and they're so excited about it because they got their cash and they can do what they want to do with it now.
Yeah. Right. Yeah. And they save a little bit, and they can get it if they want, but hopefully they'll just leave it there and then it'll be there for taxes in case they die, or in case they're doing 30 years. I mean, if they live another 30 years, that's, God only knows what, right? You know,
right,
I mean,
right.
It could probably definitely easily pay the taxes in 30 years, easily.
So some wonderful tax strategies. And as a real estate agent, if you're able to present this to your client, what did that just do to you as far as helping you stand out from all the other real estate agents out there? You know the gal who's got
that
the
much
keys
smarter.
to this kingdom. You bet.
Yeah, this has been great. Everybody should be listen to this one 3 times and let it sink in, because this is some awesome stuff here, Diane. So let's wrap this up talking about your free gift, Diane. As you know, everyone that comes on the show brings a free gift, and what I'm going to do with this, I'm going to put it on hibandigital.com/Diane Gardner and the number 2, and that's DianeGardner, Diane Gardner. And by the way, I'm going to put all of Diane's social links. I'm going to put all her a link to her business page, everything. Okay, so you guys can reach out there if you want to talk to her, get some more advice, say thank you, whatever. And I'm going to also put her free gift on the same homepage, which is hibandigital.com/Diane Gardner. Now, in addition to that, I'm also going to put this in the Agent Success Toolbox. So you can get this along with over 100 other tools that all of our guests have brought over the years. And that's at hibandigital.com/toolbox, or just text the word toolbox to 444-999. What do you got for us today, Diane?
I have a copy of my Congress Cut Taxes, 16 Ways You Can Take Advantage of the New Tax Law and Save Money.
I love it. I love it. Everybody should print this out and put it on their wall, or give it to their accountant, or give it to somebody, because or make this happen. Check off one by one which ones apply and which ones you could use. So this has been great, Diane. I really appreciate you coming on. I really appreciate you gauging and speaking in real terms, and speaking in terms that everybody can understand, and helping the realtor community at large. Thank you so much. And listen, best of luck to you in all your future endeavors.
Well, thank you, Pat. It's been wonderful. This has been had a great time getting to talk to you, and hopefully we can save some tax out there in the real estate community.
Absolutely. Thank you so much for tuning in to Real Estate Rockstars. If this free content is giving you a ton of value, I want to ask a small favor in return. I need you to pull out your pointing finger and hit the subscribe button. Yes, hit subscribe, please. The more subscribers that we get on Real Estate Rockstars, the better guests are attracted to the shows. We'll get more guests from the top companies, from the top teams, and even more celebrity guests like Robert Kiyosaki and Barbara Corcoran. Also, if you're not a member of our free Facebook group, go to Real Estate Rockstars Radio right on Facebook and join the conversation. I'm on there myself on FaceTime Lives, and we have a lot of communications and questions about the show, and I'd love to see you there. And it's free. People ask me all the time, where am I on social media? I'm real easy to find. Just type in my name. My IG is I am Pat Hyben. It is blowing up on Instagram, adding tons of subscribers, and I'm on there probably twice a day. So definitely follow me on Instagram, as well as everywhere else. Thanks again for listening, and keep rocking.